And my goodness, it was a big week for tech stocks, with 4 of the Mag's 7 members reporting quarterly results. These are some of the most powerful and expensive companies in the world. As part of our tech investing playbook, we want to talk about how investors can understand whether a tech stock is worth the price. One of the most commonly used metrics to measure value is something called the PE ratio, which measures a company's share price relative to its earnings per share. So here with more, we've got Jessica Inskip, who is the Director of Investor Research at stockbrokers.com. Jessica, good to see you. Good to have you back here with us. So help us dig into this definition, starting with what a PE ratio tells us about a stock versus what it doesn't tell us.
Yeah, absolutely. So like you said, we're looking at the price relative to its earnings. You may look at Berkshire Hathaway, Class A, and say that's a very expensive stock, and then compare it to Apple and think that that is less expensive, but that's really not normalizing it. So a PE ratio gives us an equal playing field, so we can normalize it and understand if it's expensive relative to its earnings in comparison to something else that could be a sector, another security, the overall broader market. And it essentially tells us, the definition anyways, what investors are willing to pay for $1 worth of earnings. But it's important to take that such a step further when interpreting it. So, for example, if something has a very high PE, it always tends to be tech stocks because it's the price divided by earnings. If there is higher earnings potential, that means there's going to be a higher PE ratio. But we expect that from tech because it's growth, where you might have something that's more low beta, like a consumer staples, that's going to historically and currently have a lower PE ratio. So we have to think about the numbers and the math equation to really utilize it.
Okay, so let's take this one step further and expand it a little bit. What about trailing PE, price to earnings, versus forward price to earnings, and how are those different, and when should you be kind of applying your knowledge around each of those?
That's such a great question and a very common misconception, especially in the self-directed investing world. I see lots of investors look at the trailing 12 months to understand if something is expensive or cheap in terms of valuation now. That's not necessarily true. We want to look at a forward PE ratio. Right now, the S&P 500's current forward PE ratio is 20.3. Historically, their 10-year average is 18.3 and the 5-year is about 19.9. It's more technology driven because of this AI. So I expect we're seeing those averages increase higher as well. But that is telling us forward expectations. We want to know, what is the earnings potential of this security that we're looking at? Tech specifically, how is AI going to translate into earnings? That's constantly what we're saying on finance media. I expect this AI agent to translate positively into earnings. If that translates positively into earnings and we have higher growth expectations, well, then that's going to transfer into the way that we look at PE ratio. So meaning, even if you see something that has a high PE ratio because the price is inflated, and you may think that the divisor isn't necessarily true. So when we're looking at this, we want to decide, is the price where I think it's going to be? That's the top way, or the very common way that PE ratio is utilized with that trailing 12 months, which is the past. Whereas the way to look at it for a future investment is looking at forward earnings potential. And you're going to decide, is the price too high? Or is the earnings potential not high enough or low enough? And there are lots of other factors we can look at to make those decisions.
And so some of the sky-high valuations that we started off the year with have improved a little bit, retraced just a smidge. The excitement of AI that you were talking about, and all of that considered, is PE still the best tool to measure the true value of tech stocks, or is there something else you're looking to?
I think it's great to have a well-rounded toolbox. So it's important to look at forward PE ratio. That's our first step. Then I want to look at earnings growth and earnings expectations. And I also want to look at profit margins as well. That's extremely important. And then we have to consider our macro view as well. If we're in a restrictive environment, usually, because there's a lot of CapEx spending, there is a lot of borrowing that occurs. Well, if they're going to have to roll over their debt and pay more for borrowing in order to innovate, if interest rates remain high or elevated, that that could be bad on the earnings potential. So you have to think about the overall equation. So it's important to think about other types of like positive cash flow is a really great example, but you can also even layer on analyst expectations. You don't have to necessarily go into the details of this, but the starting point I think is great to utilize forward PE ratio and then layer on your process from there.
So how do you compare different areas of technology, like software versus social media? I mean, it's going to be different when you're looking at, say, an Oracle versus Meta platforms when it comes to value.
Absolutely. So this is where you have to do your homework. We can start with that PE ratio. I want to look at earnings per share growth. Going back to the basics here, because it's literally what you're saying if you think this is undervalued. I think earnings potential is not recognized. There should be a higher denominator here, and that's going to justify the super high numerator, which is the price part of the equation. You need to look at earnings expectations, and if you think that it's incorrect or not recognized, like in the case of AI, because we don't understand it. Just like back in comparing it to when the internet first came out, it was very difficult to evaluate because we don't actually understand how it's going to translate into earnings. But what we can look at, this is where the past is very helpful. Has the company been missing earnings expectations or have they been beating earnings expectations? If they've been beating earnings expectations by a very large amount, well, that tells me that analysts aren't even doing a good job coming up with that E part of the equation. Therefore, you could justify those valuations. At that point, when the earnings potential is where I want to focus on with tech specifically. That's when we can compare against a sector overall, bring in those same numbers, drill down even into the industry or even specific peers, putting Google right next to Meta, right next to Amazon, even though they're different business models, but related from an AI perspective.
Jessica, good to break down these definitions with you. Appreciate the time.
Thank you.